Okay, in this video, I'm going to give you your next assignment, your next little exercise, and it's really important that you do this one. It's not one that you can actually skip. You need to build your grid. Now, I covered this in a previous video in terms of what it is that you need to do, so I'm just going to recap that quickly. I'm not going to repeat everything that I said in that video. Basically, you need to be aware that instruments move at different rates, okay? And some move really quickly and really far, and some just take forever to do anything. So some of them obviously lend themselves better to a day trading strategy than others. Now, if you are happy to hold trades overnight, you don't need to worry about that fact really. If you're happy to do it, it doesn't matter if some of the trades run into the next day. That's entirely up to you. Some of you will just prefer to cut at the end of every day and then go to sleep and not worry about it. Again, that's totally fine. And this is why you need to build your own grid, okay? Because some people will want one thing and some people will want another. Anyway, here we are on Pound Jappy, the absolute beast that is Pound Jappy. The 100 pip levels are drawn on by the indicator. And what you can immediately see is if you look at a couple of these days, let's just take these days here. 1, 2, 3, 4. That's a 400 pip day. This one here is 1, 2, 3, 4, 5, 6. And then we've got half here and half at the bottom. That is a 700 pip day. This one here, 1, 2, 3, 4, 5. 500 pips in a day. So in a single day, it is crossing multiple 100 pip levels. And you can see that even the average days, look, most of them are doing at least 100 pips. So it's quite easily getting from one side to another. Now, from a day trading point of view, this is excellent because obviously within these daily candles, they don't just go in one direction. There's retracements, there's pullbacks, and this is what's letting you out. So this is what you want to see, okay, is something that's getting between the 100 pip lines relatively often. Now, if Pound Jappy is too much for you, and it is one of the most volatile pairs, then don't trade it. Try something a little bit less volatile. Now, at the other end of the spectrum, we have Euro Pound, which is the example I gave in the previous video where I explained this. What I've done is I've actually marked how long it's taken for it to cross 100 pips. So from here to here, sorry, let me just zoom in a little bit. So when it crossed from here to here, that took 9 days. 9 days to do 100 pips. The next time it did it, in 27 days. The time after, 8 days, 39 days. And this one, 38 days, 62 days. 62 days to move 100 pips. Compare that to Pound Jappy, which did 700 pips in a single day. That's 2 months on Euro Pound. Euro Pound, 2 months to move 100. Okay, so potentially then 14 months to do the same as what Pound Jappy did in a day. So if you're day trading, then the chances are that Euro Pound is going to keep you in trades overnight quite often if you use a relatively large grid, or certainly if you use the same size grid as Pound Jappy. So you need to fit it. Now you can see there are reversals in here, and remember this is what lets us out at a profit when we're wrong. But if you look at the actual candles, the actual daily candles, we've got nice big wicks at both ends. So there's lots of reversals happening during the day. But you would need a considerably smaller grid size to actually be able to catch these reversals and benefit from them. So on Pound Jappy, you might be doing something like a 5 pip or 10 pip grid. Now, what you've got to realize, think about the video where we talked about spread and the cost. You're just going to pay a larger percentage of the move to the broker. So if you're only making 10 pips now, or 5 pips, and your spread is still 1 or 2 pips, you're just giving away a load of that to the broker. You're doing a lot of work for very little, essentially. But this is what I'm talking about, fitting it to each pair. Now then, what I suggest you do, obviously pick your favourite pair, some of your favourite pairs, and apply this to them. And I'm just going to show you what I would suggest. Let me go back on Pound Jappy just because it's an absolute beast. Drop down to a 5-minute chart. Apologies, I'm losing my voice. I've been talking for ages. Okay, let's have a quick look. So this will do. Let's get rid of that. I'm just going to quickly stretch my grid across. Now remember, this is just the default settings that I've shown you so far. Each one of these is 20 pips. And what you can see straight away is we're getting some nice reactions and turns on the 20 pip levels. So this looks like it works quite well, but what you have to be aware of is obviously Pound Jappy is capable of just doing this and just shooting off 500 pips. Now in that case, at 20 pip entries, you're going to trigger a lot of trades. So it would make more sense then to de-risk and stretch this across 2, and then you've essentially doubled the size. These would now be 40 pips apart. And again, actually look at how nicely, okay, it is turning at these 40 pip levels. So potentially something like this now. Okay, you can see that this still works very nicely, and that would half the amount of trades you had on, and also, you know, reduce your drawdown dramatically. So this is the kind of thing you need to do. Another thing that you need to think about is whether or not you're going to keep the actual grid size constant. So in other words, after so many trades, are you going to keep it at whatever setting it was on? Or are you going to then change to a smaller size? Or are you then going to change to a larger size like this? Okay, so if I just zoom out so you can see that, this is the next thing you need to consider with your grid. And you also need to consider whether or not you're going to continue to trade at the same lot size. Okay, so maybe while you're in the initial 100 pip zone, are all the trades going to be the same size, or are you going to have larger trades when it reaches the 250, sorry, not the 250s, the 100 pip round numbers? This would also apply to the Dow with the 250s. At these points here, at the top and bottom, are you going to add a larger lot size to help it recover, because it's much more likely to bounce from these levels? Now, once you've sort of worked out the settings that you want to use, what you need to do is essentially take your grid, okay, and then go back and actually do a little bit of back testing and say, okay, how big was this move? How big was the drawdown? What was the result? What was the profit? Sort of do this, you know, for a couple of days, couple of weeks, find some of the big moves on the chart and back test it and see what the result was. How much trouble did you get into? Was that drawdown uncomfortable? If it was, de-risk it, change the settings, reduce the risk. Or if you can't get it to work, as you may find is the case on Pound Jappy, trade a different instrument, you know, pick a different instrument. But it's really important that you do this now, because if you literally just start using the default settings of just a 20 pip grid on everything, it's not going to work on everything, okay? And certainly if you don't take the time to actually backtest it and do, I would say, at least a couple of weeks, and just to get a taste, if nothing else, just a taste, and find some of the biggest moves on the chart and test them. If you don't do that, you really don't know what to expect, and you're really not controlling your risk at all. You are essentially just hoping, okay? And that usually doesn't end well. So this exercise does require quite a bit of effort. You need to find your pairs, you need to build your grid, you need to play with different settings. I personally, I'll give you some recommendations. Start with the 20 pips, start with the default, okay? Start with an instrument that moves 80 to 100 pips a day. Remember the Mathaf website. And I tend to increase the risk, increase my lot size, only on the turning points, which would be the 100 pips, sometimes on the 50 if it's moved a decent amount. So what do I mean by that? Well, imagine that price actually started down here and then it came all the way up to this 50. Then I would be happy adding a larger lot size up here when it's got some decent stretch and it's very likely to retrace. I don't just do it every time price sort of like reaches the 50. I wouldn't do something like that. I also wouldn't do it every time it reaches the 200. You can see here, look, price, this is a pretty perfect example. Let me quickly cover this one with you, look. So price came up. In fact, what I literally just pointed out has happened here. Okay, that very last thing I drew on the chart, price came all the way up. It crossed an entire zone and then it got to the 50, and that is where it chose to bounce from. So that was the point to increase your risk. That's what I do. Okay, that's one example. The other example I want to quickly show you is actually, look, in the current zone, if you hadn't traded this bit, if you'd only started trading here, for example, look, price fell down from the 50 to the 100 pip round number. So this here was a good point to increase your risk and put a larger trade size on and help to recover it. So it has to be, you have to consider the context as well. It's not just using fixed settings on the grid. It's a little bit dynamic, okay? It's a little bit fluid. You have to sort of see how far has price moved, what is price actually doing. It's in an uptrend. This is likely to bounce from this round number level. You've just got to take a few more things into account as well. It's more about the context, okay? So please do this exercise. Don't skip it. It's very, very important. Okay, in this video, I'm going to give you your final little exercise to do, and this is it's going to be an eye-opener, okay? What I want you to do is draw a little fib on any instrument between the 100 pips or between the 250s on the Dow or the NAS or whatever you're doing, and I want you to predict the direction. So every time price gets to one of the lines, you have to predict the direction, but only for one one level, okay? So you literally need to say, look, price has reached here. So you need to say, is it going up to the next one or is it going down? That's it. There's no stops, there's no recoveries. I don't need to worry about that at all. I want you to literally just see how often you are right and how often you are wrong. So here we have a right and wrong column. So let's say I think it's going to go up. Okay, don't cheat, put your prediction on. Say you think it's going to go up, and then you literally need to see if you are right or wrong. Let me get rid of that. So let's just see. Okay, so that's made it. So that is one for right. So then what I will do is I will just mark that. I'll put one in the, try that again. I'll put one in the right column, okay? And then each time you're right, you need to keep putting another mark in, okay? If you're wrong, you need to mark it in the wrong column. And what I want you to do is, ideally, you want to do 100 at least, okay? 100 at least, and see what your actual win rate is. I guarantee it's going to be somewhere around 50%, okay? And what you can do is you can try all the different methods of analysis that you actually love to do. So order blocks, dojis, pin bars, supply and demand, support and resistance, absolutely anything. Remember, the grid size can be anything. It doesn't have to be 20 pips. You can stretch it out. It can be 100 pips. You can do this on the daily chart. You can do whatever you want. But I want you to take 100, well, not even trades. I want you to take 100 predictions, okay? And then see how many times you are right versus how many times you're wrong. And what I think you're going to find, and feel free to share the results in the comments on this course, what you're going to find is that pretty much nothing improves your prediction beyond about 50%. You probably have some tests that finish maybe 52, 53, 54. That's not significant. If you then ran that test again and did another 100, you might find that then it's 46, 47, 48. So the two added together, again, comes out at about 50-50. If you've got the patience and the time to do it, I would do 1,000 of these. Most people probably won't. You'll probably stop at 100. Break it down into tens, do 10 tens, and see each time out of each 10 predictions, what was your win rate? Now, each one of those sort of 10 predictions will vary. You might have one where you get 9 out of 10 right, and that would be brilliant. But you could also have one where you get 9 out of 10 wrong. But what you're going to find is that the more you do, the closer you get to having done 100, the closer you're going to be to 50-50. And what I'm trying to sort of make you realize with this exercise is that pretty much whatever method of analysis you use, it could be trend line bounces, MAs, absolutely anything, whatever your favorite analysis is. And this is because people ask me this all the time. Why don't you tell us how to find the direction? Because it doesn't matter. This is what I'm trying to prove to you with this exercise, is pretty much everything that you think works doesn't, okay? And you'll pretty much always come out at around 50% accuracy. So if you always come out at around 50% accuracy, use a strategy like mine where you get to add recovery trades and you get to win 90% of the time, even if you're wrong. That's the whole point of this exercise. I get so many comments about it. That's why I've kind of created this, is for those people who really don't believe what I'm saying, do this exercise. Let's see how good your favorite method of analysis is. How often are you right or wrong? If you do get some awesome win rate, please share it, comment on the course, because I think everyone would like to benefit from it. Welcome to the brokers section. So in this section then, I'm going to cover regulated and unregulated brokers, and obviously give you a little bit of advice on the way to go. I'm going to talk about account types, so STP versus ECN, and which one is actually the cheapest and the best type of account for you to use. Then I'm going to talk about A, B and C book brokers and explain basically what you should look out for, what you should avoid. US traders, I'm going to help you out with FIFO rules. And then finally, I'm going to talk about leverage and spreads and the way that brokers sort of make it difficult for you to trade certain instruments and how you can get around that. So I'll see you in the next lesson.